Become a savvy investor by acknowledging your limitations. When you invest in stocks, you're thinking about risks and rewards, but there's a big risk that many people ignore. It's our own behavior. Sometimes we make irrational decisions because of emotions, too much information, or persuasive advertising. On this episode, we'll learn about the common mistakes investors make and share practical tips for making smart investment choices. You'll find out why prices matter, how to trust a company's management, and why being too excited or panicked is not good for investing. Lesson number 1. We overestimate our abilities in life and when we invest. Early on, we're taught to be positive and confident, but too much confidence might not be helpful. For instance, a study found that many American high school students wrongly thought they were really good at math compared to the world, when in reality they were just average. This overconfidence bias happens when people think they're better than others. In another study, employees were asked to rate themselves on things like interpersonal skills and physique. Surprisingly, everyone thought they were above average, even in areas where not everyone could be exceptional. This shows that people tend to overestimate their abilities. But is it really a problem to be overconfident? Well, when it comes to investing, it can be. If you believe you're exceptionally skilled, you might credit your successes to your talent and blame losses on external factors. This is called a fundamental attribution error, making it hard to learn from mistakes. Thinking you're exempt from market rules can lead to ignoring risks and making risky decisions. Overconfidence might also prevent you from seeking advice. Being humble about your abilities, learning from mistakes, and being open to advice are crucial for becoming a successful investor. Lesson number 2. Our emotions can affect our ability to make good decisions. Extreme emotions like crying during a sad movie or feeling excited in love make life interesting. However, in investing, strong emotions can mess up your decisions. In a study, people who watched a boring video about fish made better choices in a pen-selling scenario compared to those who watched a sad movie. They charged 33% more for their pens. Positive emotions like excitement can also lead to risky decisions. For example, investing in high-stakes deals can stir up strong emotions. Both positive and negative emotions can impact decision-making. The solution? Getting an investment advisor helps you stay calm and make rational choices. Lesson number 3. One of the best investing decisions you can make is to get an advisor. Investors may know the rules and read many books about careful planning and avoiding impulsive buying, but just knowing isn't sufficient. That's why hiring an advisor is crucial. Studies show advisors significantly help investors make better decisions, leading to higher financial returns. Morningstar estimates a 2-3% annual outperformance for investors with advisors. Advisors are especially valuable during crises. In the 2008 financial crisis, those with advisors outperformed others by 2.92% in the following critical years. Advisors not only provide statistics but also serve as behavioral coaches, challenging investors and helping them consider potential risks before making emotional decisions. It's essential to thoroughly interview and choose an advisor who aligns with your needs, credentials, investment philosophy, and behavioral coaching skills. Lesson number 4. Don't panic about investment panic. Imagine putting some of your savings into a company, only to find out it's being investigated for fraud. That news can make you panic. As an investor, you'll be confused with information from news outlets hungry for scandal. If you're not careful, you might make fear-driven decisions instead of sensible ones. People tend to exaggerate problems, especially when it comes to finances. If your stocks dip a bit, you might immediately imagine the worst, like ending up broke and relying on your kids for money. The media often treats stock market dips as crises, but it's normal for stocks to lose value occasionally. Sometimes, Stock prices are too high and people start selling in bulk to make a profit. This is called a correction and happens about once a year, with stocks losing over 10% of their value. These dips usually don't harm your overall stock portfolio in the long run. However, if you panic and sell your stocks immediately, you'll end up selling at a loss. Interestingly, the scariest market times are often the safest. When things are going great, you might feel confident, but high prices can indicate a bubble. After a price drop and market correction, it may feel terrible, but it's a sign of a more stable market with accurate values. So don't rush to react when trouble arises. Handling market ups and downs is part of being a successful investor. Lesson number 5. Learn to identify a dodgy company by evaluating what the management does, not what it says. Avoiding investment scams and deceitful individuals in finance is crucial. Research shows that detecting lies is challenging, with only a 47% success rate in spotting liars through body language. Even trained professionals like law enforcement were only successful 42% of the time. For investors, the key is to focus on executives' actions rather than their words. Instead of trying to figure out if leaders are truthful, observe where they invest their own money. A study found that companies with significant insider buying tend to outperform others on the stock market, making it a reliable indicator of a good investment. Lesson number 6. The highest price isn't always right. So when investing, go for value over glamour. Would you spend $52 on an old oven mitt? What if I told you it once belonged to a famous chef and got burnt making her first beef bourguignon? When buying stocks, we often overvalue things just because they're expensive, not based on their actual worth. An experiment showed people enjoyed food more when told it was expensive, even if it was the same as cheaper food. Buying stocks solely based on their popularity, like glamour stocks from fast-growing companies, can be risky. They might rise quickly, but if you buy at their peak, you could lose money when the hype fades. Instead, consider value stocks from smaller, less-known companies. They may not be popular, but they have room to grow. It's like picking the underestimated kid for the basketball team. They might surprise you with steady performance, just like value stocks quietly gaining ground while glamour stocks rise and fall. Lesson number 7. Be wary of being seduced by novel and exotic investments. In the 1600s, tulips became super popular in the Netherlands because they were colorful and had a unique shape. People went crazy for them and started paying crazy prices, even up to 10 times what a worker earned in a year just for one bulb. But in 1637, this tulip craze crashed, marking the end of a wild period of speculation. Why do we get so hyped up about new and exotic things? This excitement has led to bubbles bursting in economic history, like the dot-com bubble. People were so hyped about the internet's potential that they threw money at any company with a .com in its name, even if they weren't making much money. Take etoys.com, for instance. It got $8 billion in investments in 1998 despite only making $30 million in toy sales, while the old-school toys, R Us, made way more sales with much less investment. But etoys.com went bankrupt in 2001, showing that investors were blinded by the hype. The same goes for air travel, which has always been seen as exciting and exotic. It's changed how we live and think about the world, but investing in it to make money has usually been a bad idea. High costs and tough competition mean investors often lose out. So, when you're tempted to invest in something new and exciting, remember the tulip frenzy. Sure, it looks good, but is there real value behind the hype? Is it worth risking your savings for? Lesson number 8. We need to invest our money according to our personal goals rather than other people's rules. How much money do you need? Different people have different answers. Some say you should save 10 times your yearly income, while others compare themselves to neighbors. But the best way is to look inside yourself. We all have unique needs that make us feel fulfilled. After covering basics like food and housing, personal needs vary. Some need a lot in savings for security and their kids' education, while others prefer having cash for experiences like travel. Your needs set your benchmark and guide your investments. Clearly stating this benchmark helps you navigate market ups and downs. For instance, if you won't touch savings for 15 years, market dips don't worry you. If you're supporting a parent with unpredictable costs, you need a less risky plan. To align financial decisions with your goals, change how you talk about money. Naming the purpose of savings helps. Behavioral psychology shows attaching goals like kids' education to money motivates saving. When investing, consider your needs, values, and ensure decisions match your dreams. So, in summary, investors face a big risk not from the stock market, but from their own emotions and irrational decisions. To stay on track, it's important to recognize these weaknesses, seek advice from others, and stick to a systematic approach aligned with personal goals. Thank you for watching. Don't forget to like, comment, and subscribe. Watch more videos by clicking on this video right over here.